Hi, everyone. I'm Harold Leishman, Portfolio Manager and Senior Investment Advisor with CG Wealth Management. I'm a partner with LLC Private Wealth, and I oversee the small cap specialist group here at CG Wealth in Vancouver. This is our segment Under the Radar, where we talk about changes or highlight positions we have in our small cap portfolio. Today, we're looking at Monument Mining, which has shown 200% revenue growth over the last 4 quarters and currently trades for about 2.5 times earnings. Monument, headquartered in Vancouver, has operations in Malaysia and Australia. Got about 328 million shares outstanding, $150 million Canadian market cap, with about 30 million US of positive working capital on their balance sheet. They started the Selinsing mine, their key asset in Malaysia, in 2007, and in late 2023, they completed a significant upgrade to their production facility there and took their production from 2,000 ounces a quarter up to 8,000 ounces a quarter. At the same time, gold had a really significant move from about $1,900 US an ounce to $2,700 US an ounce. And this has driven really phenomenal revenue and earnings growth at the company. Revenue's gone from 9 million a quarter to 27 million US a quarter. Earnings have gone from 3 million to 15 million US a quarter. And over that time frame, they have piled on about 16 million US cash onto their balance sheet. It is worth noting that gold's up another $500 an ounce since our last report, and we're very excited and curious to see what that's going to look like when the next financials come out. Monument has a second operation in Australia. They've got a mill that's currently on care and maintenance. They are actively looking for partnerships in the area with other companies that have ounces and no production facility to bring a second revenue line on stream. Our take is, assuming everything stays constant, that cash pile on the balance sheet will continue to grow, providing a nice cushion to the current valuation, or driving the valuation lower, I guess, if you look at it from an enterprise perspective. And there is the chance to get some additional upside if that second mine comes on stream. Worth noting that small junior producers always trade at a fairly significant discount compared to the seniors, and until they maybe get up to maybe 100,000 ounces a year, the company will always trade at a discount. However, we think the downside risk from here is worth taking on, given the company's positive cash flow. In addition, in mining, there are additional risks that go beyond other companies. In this case, they're a single producing company. If there was any sort of operational mishap in Malaysia at the Selinsing mine, it would have a dramatic impact on obviously earnings and revenue. You've got commodity risk. Commodity-based companies are a double-edged sword. When commodities go up, there's huge operational leverage to the upside. Conversely, when prices go down, earnings and revenue will also take a fairly significant hit. Malaysia, there's some political risk there, and just general operational variability at the mine could drive some significant variability in the company's earnings. All of that said, Monument fits nicely into our framework. We're looking for high revenue growth, high margins, low valuation, and some sort of free optionality. If you're interested in learning more about our process or other companies we have in our portfolio, please feel to reach out with any questions. We're always happy to talk small cap stocks with cash flow, or talk about our process. Thank you so much for your time and for listening, and we'll see you again soon.